What if understanding one number could quiet most of the noise you hear about markets? What if instead of guessing, reacting, or chasing headlines, you had a calm reference point you could return to again and again? That's what this session is about. We're walking through what is a stock index, unlocking the pulse of financial markets. Stick with it slide by slide and notice where your own habits might be working against you and how small shifts can fix that. We begin on the title slide, What is a Stock Index? Unlocking the Pulse of Financial Markets. The phrase, unlocking the pulse, matters. A pulse tells you if something is alive, stressed, or stable. Markets are no different. The quote here from John C. Bogle about owning the market and letting time do the heavy lifting sets the tone. This deck isn't about speed, it's about direction. If you've ever felt rushed to do something in investing, that urge might be the problem. And notice the PDF handout mentioned here. The link is in the description below. Keep that in mind. It's meant to slow you down and help you think, not react. Moving to the agenda slide, we see the path clearly laid out. What an index is, why it matters more than stock picking, the types and signals, how investors use them, and the risks. This is important because many people jump straight to what should I buy without understanding the map. If you've done that before, ask yourself, were you acting from clarity or from pressure? This agenda promises structure. Structure is often what's missing when people feel lost in markets. On the next slide, the core idea, we hear it plainly. A stock index tracks the performance of a selected group of stocks. One number, one signal, a snapshot. In simple terms, instead of staring at thousands of moving parts, you zoom out. If you've been obsessing over individual stocks and feeling overwhelmed, this slide is quietly telling you why. You're trying to read every leaf instead of checking the weather. So ask yourself, where could zooming out reduce your stress? Then we ask, why indexes exist. The bullets tell us markets are too large to track stock by stock, indexes turn chaos into patterns, and they act as benchmarks. This builds directly on the last slide. Once you accept that one signal can be enough, you understand why it exists. Many investors mess up here by thinking more information equals better decisions. Often it's the opposite. Indexes filter noise. If your decisions feel chaotic, maybe your inputs are too crowded. What would happen if you measured yourself against a benchmark instead of a headline? Now we arrive at types of stock indexes. Market cap weighted, price weighted, equal weighted. This slide answers a common confusion. Why do different indexes move differently? Because they're built differently. Market cap weighting gives more influence to larger companies like the S&P 500. Price weighted, like the Dow, reacts more to expensive shares. Equal weighted spreads influence evenly. As Bogle teaches in the Little Book of Common Sense Investing, structure shapes outcomes. If you've blamed an index for not behaving, maybe you never asked how it was designed, which structure actually fits your goals. Next is behind the numbers. Price times shares equals market value. Divisors maintain continuity. Free float improves accuracy. This slide demystifies the math. You don't need to calculate it, but you should respect it. Many people skip this and assume indexes are arbitrary. They're not. They're carefully adjusted to stay honest over time. If you've ever distrusted market numbers, ask yourself, is it the math you doubt or your understanding of it? Often, confidence grows just by knowing there is a method. On iconic benchmarks, we meet the S&P 500, Dow Jones, and NASDAQ. Each tells a different story. The S&P speaks for broad U.S. business health. The Dow reflects legacy giants. NASDAQ leans into innovation and technology. This connects back to types, different lenses, different signals. If you've been using one index to judge the entire economy, that's a common mistake. The fix is simple. Ask what story this index is actually telling. Context changes everything. Then we land on why indexes matter. Most active funds underperform. Lower costs mean higher net returns. Indexes anchor expectations. This is where evidence steps in. Decades of data show that trying to outsmart the market usually backfires. As covered in a random walk down Wall Street, effort doesn't guarantee advantage. If you've been switching strategies often, thinking the next move will fix everything, this slide gently challenges that. What if consistency, not cleverness, is the edge you're missing? Next, using indexes wisely. ETFs and index funds, Benchmarks for review, signals, not predictions. This slide corrects another trap. Indexes don't tell you the future, they tell you where you are. Many investors misuse indexes as forecasts and then feel betrayed. The better use is orientation. If you're lost, you don't need a prophecy, you need a compass. Are you treating market data as guidance or as a guarantee? Then we face limits to respect. Bubbles happen. Concentration risk is real. Indexes follow markets. They don't protect you. This slide adds humility. It builds on trust without promoting blind faith. During tech bubbles or sector booms, indexes can still fall hard. If you assume index investing means no risk, that's a misunderstanding. The fix isn't fear, it's balance. Are you diversified beyond what feels exciting right now? We pause and reflect. The question asks, what if your goal isn't beating the market, but staying invested long enough to benefit from it? This is where many people stumble. They quit early. They tinker too much. They react emotionally. This slide invites honesty. Where have impatience or comparison pulled you off track? And what would change if endurance became the goal? Finally, the final thought. A stock index isn't a shortcut. It's a compass. Steady direction beats constant motion. This closes the loop back to the opening idea of a pulse. You don't need to sprint to be successful. You need to stay oriented. The PDF handout, again, link in the description, is there to help you revisit this when noise creeps back in. If this walkthrough helped you think more clearly or caught a mistake you've been repeating, do yourself a favor. Subscribe to the channel. These are the kinds of frameworks that compound over time, just like investing itself. And before you move on, ask yourself one last question. What's one habit you'll simplify after this video?